Everybody's talking about the yield curve inverting again because if you remember a few months ago, the yield curve, it inverted and everybody said, hey, the yield curve inverted. And then the Fed came out and said, no, we don't like that inversion measure anymore. That one doesn't count. We've got a different one that we think is more accurate. And by the way, it hasn't inverted yet. Well, guess what? We've now gotten to the point where even their preferred measure of the yield curve has inverted. So what does that mean? Ready? Let's dive in. So first question, what is the yield curve? The yield curve is just plotting out what the yield is on debt for given maturities. In a normal environment, the longer that debt is, the higher the interest rate will be. You're going to get a better interest rate on a 15-year mortgage than you will on a 30-year mortgage. Why? Well, number one, you're paying that debt back faster, so there's less risk on the lender that you'll default on most of the money. Also, there's less amount of time for something horribly catastrophic to go wrong. If you want to borrow money from me and pay me back tomorrow, I might not charge you any interest at all. It'd be like, yeah, here's some lunch money. If you want to borrow some lunch money from me today and you say, hey, I'll pay you back in 2 years, I might say, hey, wait, then let's arrange something here. Maybe you pay me back a little bit more because what if costs go up between now and then? I'll give you $10 for lunch today. 2 years from now, that same lunch might cost $15. So if you give me $10 in 2 years, that might not be enough for me to buy my own lunch at that time. And so I'm going to charge a little bit of an interest rate to compensate me for the risk of inflation or default or you just skipping out of town after you get my lunch money. So that's normal and that's very simple to understand why. Well, an inversion that you can see right here on how inverted the yield curve is when shorter term debt gets more expensive than longer term debt. So this is a situation where I say, hey, you want to borrow lunch money from me and you'll pay me back tomorrow? Okay, you'll owe me $15 tomorrow when you give it back. But if you give it back in 2 years, you don't owe me any interest, right? That's preposterous. Obviously, that's an extreme amount of dollars there, interest rate and inversion, but that's what's going on here with an inverted yield curve. Longer term debt is cheaper than shorter term. Now, historically, what people have always paid attention to is the inversion between the 2-year Treasury and the 10-year Treasury. That is the hallmark. That's the big marker. That's the bookmark. That's what everybody watches and says, hey, when that inverts and the 2-year yield is above the 10-year yield, that is the sign that has historically been very accurate at predicting a recession. And that happened a while ago. It happened before August or September of 2019, predicted the 2020 recession. It also happened before this recession, which we had 2 back-to-back quarters of declining GDP in 2022 in first quarter and second quarter. And so it predicted that recession as well, even though most people say, hey, that wasn't actually a recession for some reason. And so the inversion of the 2 and the 10 has been extremely accurate at predicting economic hardship and recessions. But the Fed came out when the 2 and 10 flipped and said, no, we don't like that one. We like the 3-month Treasury bill versus the 10-year. And now even that one has flipped. Now, it's not all manipulation here. It's actually, there is a little bit of rational investing going on here because investors are looking at the Federal Reserve who are raising interest rates to bring down inflation. And the more aggressive the Fed gets with raising interest rates, the more chances there are that there's a catastrophic collapse in something in the economy, right? Lots of economic pain, job losses, everybody defaulting on their debt. The higher interest rates go, the more chance there is for economic hardship. And the more chances that are that happens sooner. And so if interest rates go up right now, the Fed crashes everything down, that means that inflation is solved. That means that deflation enters the chat, which suddenly means if prices are going down, a lower interest rate is attractive. You don't need to demand 7% for 10 years out. You only need to demand 2% for 10 years out because you know between now and 10 years from now, that 2% is going to be pretty nominally positive, or in real terms, it'll be pretty positive versus in the next 3 months, we know that's not going to be positive. So in the next 3 months while inflation inflation is still high, I'm going to demand a higher interest rate. But over the next 10 years, if I'm expecting some severe deflation, I'm willing to accept a lower interest rate because then I'm locking in a real positive return between now and then when we're going to have some sort of a severe recession. And that's exactly what investors are saying here. It will be difficult for the Fed to not over-tighten as inflation lags the economy, so they're focused on slaying the inflation dragon, which means it's a time for sticking with quality bonds. We have no problem extending duration in treasuries. So in conclusion, if you expect deflation to happen at some point in the next 10 years, then any rate that's nominally positive will be real positive. Because for the next couple of months, for the next 1 year, maybe 2 years, a 3% or a 4% might be negative when compared against inflation. But over the next 10 years, that 3% or 4% might be positive considering the deflation that might come soon. As always, really appreciate you guys. Thank you so much for watching. Have a great day.